Major US indices hit record high levels yesterday, yes, as technology remained the dominant force to the upside, with semiconductor names and hyperscalers extending their gaze even as geopolitical uncertainty builds in the Middle East. And markets appear to have developed a reflex, absorb the shock, then resume the trend. Oil volatility, currency hedging, and weakening macroeconomic indicators, on the other hand, are still very much present, but they're increasingly overshadowed or ignored by investors who have this renewed appetite for AI companies. But risk persists, obviously, and headline-driven moves are too close to be fully ignored still. So welcome to Swissquote's Daily Market Talk. It's Thursday, April 23rd. I'm İpek Özkardeşkaya. We will discuss a lot of things today again, but before we do, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So if you handed a market chart to an alien of any of the big indices in the world, including US, European, or technology-heavy Asian indices, well, he or she would barely guess that this world, this planet, is being shaken by intense geopolitical tensions that brought the transit at one of these planet's most critical choke points to a near halt, that this situation is being going on for nearly 2 months, threatening a man-imposed energy shortage across the planet, and that there is no light at the end of the tunnel just yet. They wouldn't guess either that the world, these planet's leaders, prefer tweeting threats on their social media platforms as a new form of diplomacy. Because both S&P 500 and Nasdaq 100 in the US posted fresh new highs in yesterday's trading session on news that the ceasefire between US and Iran would be extended without a clear deadline. But it is extended because these two countries, US and Iran, are failing to find a common ground to agree. And there is also probably too much ego and reputation damage for either party to let go. Alas, technology investors couldn't care less. They actually care increasingly less, because VanEck Semiconductor ETF rallied in the 13 of the past 14 trading sessions on renewed AI optimism. Google, on the other hand, gained more than 2% yesterday after revealing a new TPU chip designed to make AI computing faster and cheaper, while Amazon also gained more than 2% during the same session as well, after announcing a $5 billion investment in AI's new rising star Anthropic, on top of the $8 billion that they already committed into the company, and said that there could be $20 billion more to invest in, a deal that obviously includes something else from Anthropic. Anthropic will be spending over $100 billion on Amazon's web services over 10 years. Circular? Yes. But investors have now digested the circular nature of these AI deals, or they simply find that this is better than the war-exposed stocks. Alas, that circularity is not showing up between ASML and TSMC, one of his biggest clients. The latter actually complained that ASML's new machines, new gear, are just too pricey, and that they will hold off on deploying the latest gear through 2029 to save money. There's one problem, is that ASML is the only provider of advanced chip-making machines. Anyway, what's really interesting right now on the macroeconomic level is that we see pretty much the same sell-off and recovery pattern than we did last April after the so-called Liberation Day. Remember? The choice of words here is also making me smile a year and so after that day, because the US just released a week ago a web platform to refund taxes that have been illegally collected over months. But while trade tensions and uncertainties continued and continue, the major US and other world indices just kept rallying. And this is what we see today, a dip on initial shock and rebound to all-time high levels, though the situation today is worse than it was before the initial shock. So it's almost safe to say that no matter the news, the market rallies. But of course, gains also come with risk of sharp reversals as energy crisis is looming, is really building up. Because look, the US crude was trading about the $100 per barrel psychological mark again this morning on extended uncertainties in the Middle East, while Brent crude traded past the $106 per barrel level this morning, the highest levels in more than 2 weeks. and the latter is weighing on appetite in equities this morning. US and European futures are right now pointing at lower open, while the Japanese Nikkei index and Kospi index in South Korea also retreat from all-time high levels. But one thing is quite clear today: technology-heavy indices and energy stocks are outperforming other sectors as the economic outlook globally deteriorates due to higher energy prices that make economic activity pricier. And further upside is possible for crude oil prices, but gains will likely remain short-lived as at these levels the demand for oil slows down enough to contain a further upside. So far, the $120 per barrel level has indeed acted as a solid resistance to the bullish moves, and I don't really think that we would see levels like $150, $200 per barrel level when the recession talk is looming as well. So speaking of underlying economies, the PMI data today will give an idea of the impact of higher energy prices on several world economies. While the figures will likely point at slowing activity in US and Europe, and so the rising price pressures everywhere will also likely keep the central bank expectations, the central bank doves, quite contained. Because yesterday, the UK announced its latest CPI figures, and these figures just came to confirm the rising price pressures in the UK driven by higher energy costs. Core CPI was slightly lower than expected. That was a slight bright spot in that report, but it didn't change the expectation that inflation in the UK is making a U-turn today on this unexpected event of war in the Middle East, and will not only prevent the Bank of England from cutting the interest rates, but may also force the UK policymakers to tighten their monetary policy. Alas, the latter didn't help. Cable gained ground yesterday as higher rates into a slowing economic outlook is not necessarily appetizing for FX traders. Globally, the US dollar is gaining fuel again these days, but slower compared to the first days of the Iran war, as some investors still prefer hedging higher energy risks and rising energy prices with the US dollar. And while another wave of positive pressure on oil prices globally could give the US dollar a short-term boost because crude oil is negotiated in US dollar terms. But in the longer run, the US economic outlook is also weakening, and appetite for the US dollar globally is weakening as well. But happily for investors, the technology story is masking the deteriorating fundamentals of the US, and this is why we see this widening gap between the S&P 500, Nasdaq, and other major US indices versus what's really going on in the fundamentals in the economic data. Alas, this is how the markets function. Inside technology, Tesla announced its first quarter earnings yesterday after the closing bell in the US, and numbers actually came in line with market expectations. The revenue grew 16% last quarter from a year earlier, thanks to an easy comparison, as this time last year the sales at Tesla were tumbling. But the operating expenses ballooned as well. They ballooned 37% to nearly $3.80 billion US dollars. And more worryingly, the company ramped up its capex spending plans to $25 billion US dollars this year to keep up with the AI race and with the rivals, and that's basically 3 years of combined spending for the company, so it's huge. As such, the shares first popped in the after-hours trading but reversed these losses. Elon Musk has been incredibly successful in selling his technology dreams to the world, helped by a cash machine, Tesla sales, that helped keeping investors on board for years. But today, that cash machine is sputtering. So unless Elon Musk's new projects, robotaxis, humanoid robots, and AI start spitting money, investors will be pulling back. And it's quite very difficult to put a price tag on Tesla still. The company currently trades at a PE ratio of nearly 320. If it traded near a PE ratio, say, of 30, well, the share price would be around $36 a share only. Of course, it's a very linear calculation and doesn't take into account the growth potential of the new technologies that Tesla is pursuing. But it gives you a warning that when you trade a company like Tesla, well, you should make sure to understand that you are funding the dream of Elon Musk, which could change the world, yes, but also carries a very high risk. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky. for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. Until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.